What's up and what's down? I'm Lenska with Lenska Realty, and this is San Diego Real Estate Market Update May 2021. I'm not sure it matters if you're going down in flames or going up in flames. I think we focus on the flames. Let's focus on real estate investment and how we can increase our bottom line. Let's find out what the real estate market has in store for us this month. I offer ADU consulting and feasibility to increase your ROI. Also, real estate broker services, and hit me up on Meetup for some free educational events. Before we go into our real estate market update, I just wanted to let you know that the biggest discussion right now is about the inflation or deflation. And this is pretty important because normally real estate protects you against inflation. But the last US debt bubbles, peaks between 1800 and 2020, all kind of ended up in a deflation. 1838, 1873, and even right now our 2020 started with a disinflation. Our years between peaks are an average of 46, but the last crisis between 2008 and 2020, it's only 12. So what does it mean? Do we get inflation or deflation? So here we are. The savings rate is staying at an all-time high. So if we hit over 27% and elevated since the pandemic started. Some people say, is this dry powder or is it debt payoff? So if they're saving it, how did they actually spend their stimulus checks? So here's stimulus round 1, 2, and 3 in June, January, and in March. And you can see that the share spent went actually down. The savings share went up to 41%. And the share used towards debt, and that is very interesting as well, actually is above 30%. And in January, people paid down more debt. So will that help the inflation? Not really. So we look at the real estate data points, sales and inventory numbers, interest rates, employment data, the HPSI by Fannie Mae, home builder sentiment, evictions, foreclosure, forbearance. So here we are with the sales and inventory numbers. Obviously, we hit an all-time high again year over year with the median home price at $710,800, up 18.5%. The median home price detached is at $840,000 and up 24.4%. And the median home price for the attached unit is $530,000, up 21.8%. And for the first time, the average price per square foot hit over 500, which is up 25% year over year. We still have a very fast selling market between it stays on the market active for 8 days and closing about 24 days. Pending sales are obviously up, or we're comparing it to the worst pandemic months of last year. So that is no surprise, and also no surprise that the sold listings for detached and attached are up. But currently, you heard the median home price, but if I look just actually as today, but when I'm recording it, it's actually up. Not 720,000, it's up already at 727. So if you're like a real estate broker like me, I've recommended some of my sellers wait until summertime to take advantage of the higher comps. And surely I made my sellers between $60,000 and $100,000 by just waiting a few months. Now this is another indication if you compare the average closed price percent of the original list price. We're currently at 103.7%. In April, we were at 102.7%. So you see that line going straight up. This is a very hot market with a lot of overbids on properties. And also you can see the dollar volume of closed sales is just skyrocketing up. It obviously helps that the mortgage interests are still in the 3 range, but the Fed at 0 right now, but different than the mortgage rates. So the fund rates can change day to day, unlike a mortgage rate that can last for 30 years. And if you see down here at the bottom, the Fed rate, still we had little hikes of interest rates up to 4 and to 5% in about 2011 and 2014, and not to forget, actually, when the Fed rate went up in 2018, we also had a 2018 interest rate increase, which actually made the market lose about 10%. And if you want any daily mortgage updates, you can always go to Meredith at Cross Country. So there's changing right now, but interesting, if you take a $750,000 loan amount, your payment is still around $3,200, and this is where a lot of people still can afford buying a house. Employment data for April 2021. This graph shows a pretty dramatic picture because the red one is the 2020 employment recession compared to, for example, the blue line, 2007 employment recession. It was a slower, obviously, recovery, but we're still not even close to, actually a little bit higher than the bottom of the 2007 crisis. But when you can see all the other ones, they recovered much quicker. So currently the unemployment rate is at 6.1, but you guys have heard me before, I go by the U6 unemployment rate of 10.4%. I think this is a more realistic number. But a good picture right here with the job openings which increased to a record of 8.1 million in March. So you see the blue line actually indicates that if you take the bars, if it's above the bars, we're actually adding jobs. If it's below the bars, then we're losing jobs. So if you see the yellow line with the job openings, so that we might have a little mismatch of talent and job openings because some of lower paying jobs simply will not come back, as employers have noticed that they can be as productive with less people. San Diego's unemployment in April was about 6.2%. So here's something from Fannie Mae, the Home Purchase Sentiment Index. They usually ask the 6 questions: a good time to buy, sell, how will home prices and mortgage rates behave, and how confident are they in keeping the job, and also if they think their household income is significantly higher than in the past 12 months. So this indicates a little bit more of a tracks the consumer housing related attitudes, but this month in April it declined to 79 points. Why? And look at that. So I think we're seeing a little bit of a buyer fatigue, and also reflected in actually the hot rental market, and that some of the big city rentals actually are coming back because people can't find a home to buy. So they're deciding to rent. So we have seen a little negative in the buyer's condition, and we also seen month-over-month decline in the household income. So still up year over year, because no wonder with all the stimulus pumped into the economy. Unfortunately, to just echo what Fannie Mae had in their survey, that the median family income is well below where it was 12 months ago. Compared to new home prices and mortgage rates at year end 2020, the monthly payment on the principal and interest on the median priced home has increased roughly $160. So for high income earner, this increase won't make much of a difference, but it does to lower income earners. That is the ones currently dependent on stimulus. Affordability can potentially increase as the job market actually improves and wages start rising. But it could be some time before we reach a level of employment results in modest wage hikes. And that's what you see right here. Without the stimulus checks, we wouldn't have much of an economy. So how we're doing with evictions, foreclosures, and forbearances? Forbearance unwinds slowly months over months. So currently we only have 2.25 million or 4.36% of homeowners in forbearance. And we don't have to really worry too much, because even those homes have a lot of equity, and also homes are selling quickly if somebody is forced to sell a house, and so the equity also will be protected. And just a little stat here, that 87% of the homes have a below 80% loan to value, and 37% of homes are owned free and clear. In 2009, in comparison, 26% had a loan to value above 100%. Don't forget to hit the like button and also the subscribe button. And here it is. Apartment owners are out about $8 billion from missed rent payments this quarter. So during the pandemic, 23.7% of renters have missed at least one housing payment during the pandemic, but only roughly a third, as many as 8.6%, have missed more than two. Besides the CDC eviction moratorium, San Diego Board of Supervisors have extended the eviction moratorium to around mid-August. So the new ordinance takes effect in early June and lasts until some time, we don't know exactly when in August. Landlords under the new law can actually no longer evict tenants for just cause reasons, such as lease violations, and can only be removed if they are an imminent health or safety threat. So it also blocks a homeowner from moving back into their own property and kicking a renter out, which is allowed by law currently. So it all depends when Governor Newsom declares or lifts the state stay-at-home order and emergency. So check out the Housing is Key California website. There are funds, for rents, for rental assistance, and also for landlords. As I mentioned before, the national rent index is up in all the cities, so that is kind of good news. But we still don't have a good outlook on when inventory will increase. As you can still see, supply-demand gaps remains very wide. In the years, the home builders were actually producing more homes than they were selling when it is above 100%. Currently, we're at 87%, so really dragging. But we know expensive wood, expensive homes, so lumber is the key input for housing, construction, and remodeling. But unraveling the relationship isn't so easy. Are lumber prices up because builders are demanding more, or are home prices high because lumber is expensive? The answer is actually both, because with home prices, that has a supply element as well. So many producers reduced output when the pandemic struck last year, And an ongoing US-Canada trade dispute is also affecting the supply. Still, the percentage change is crazy. Like spot lumber, like this shown here, is up 6 times from April 2020's low. So at some point, the prices will force builder to postpone or even cancel construction plans, and so do homeowners. And so lumber maybe will come back to earth when we all be, hopefully when it will be, we don't know. As we know, it's all about supply and demand, but where does the demand come from in real estate? So it is all about the birth rate, and also it is about household formation in real estate. So, and interesting enough, look at it. The US population grew 4% over the past decade. That's actually the smallest increase since the 1930s. And not to mention that it is about 50% fewer than in 1960. We're still doing a little better than China and definitely better than Germany. Going back here, it's kind of a little bit of a mirror image. You can see it's down, and then it's level, and then it's up. And here, it's mirror image. We also see that the population continues to shift from the Northeast and the Midwest to the Sun Belt, and California will lose a congressional seat for the first time in history. The shifts will complicate Democrats' efforts to retain House control next year and win the Electoral College in the future. And also considering what the workplace will look like after COVID-19. Will we do hybrid working, robot colleagues, and having 4-day weeks? So COVID-19 hasn't just changed the way we perform our job, it's also kickstarted a broader push to rethink the world of work, which will affect the value of real estate. We have seen it in New York, where prices plunged in office buildings and rents. But the whole question is, are we in a housing bubble? So if you see the home price to rent ratio 20% above the long run mean, and usually we always return back to the mean. All in all together, San Diego's real estate metrics are at the highest level ever. We do see some buyer fatigue. Government is the new economy. Extended rent control and moratoriums are to be watched, and the median home price is up $75,000 since January. But be cautious. Housing, due to the huge supply-demand imbalance, temporarily is inflated, and personal income, rising rates, tightening lending standards, and the end of deferred payments that combined should lead to a little bit slower activity. And we always close out with our free educational events. The third Saturday of each month, sometimes the fourth, which will be May 22nd. Check us out on Meetup. Real Estate Investing Field Trip. Thank you for listening, and stay tuned for June's market update.